Watch video 5 on Chapter 1, Investment Landscape from the Workbook for NISM Series VA, Mutual Fund Distributors Certification Examination, and review the multiple choice questions and answers. 1. What is one of the main reasons why risks cannot be completely avoided in investing? A. It is illegal to avoid risks. B. Risks are necessary to earn decent returns. C. All investments are risk-free. D. Avoiding risks leads to higher returns. Answer: B. Risks are necessary to earn decent returns. 2. Which risk management strategy involves not taking an investment due to lack of understanding? A. Diversify. B. Avoid. C. Take a position. D. Rebalance. Answer: B. Avoid. 3. Which investment strategy requires superior market knowledge to manage risks? A. Avoid. B. Diversify. C. Take a position. D. Rebalance. Answer: C. Take a position. 4. Why is diversification a recommended strategy for risk management? A. It eliminates all risks. B. It spreads risk across various investments. C. It guarantees higher returns. D. It requires superior market knowledge. Answer: B. It spreads risk across various investments. 5. What does the term credit risk refer to? A. The volatility in stock prices. B. The risk of default by a borrower. C. The risk of inflation reducing purchasing power. D. The uncertainty of interest rate changes. Answer: B. The risk of default by a borrower. 6. Which behavioral bias leads to relying on easily recalled information when making investment decisions? A. Herd mentality. B. Availability heuristic. C. Confirmation bias. D. Overconfidence. Answer: B. Availability heuristic. 7. What is confirmation bias in investment decision making? A. Preferring familiar investments over new ones. B. Seeking information that supports pre-existing beliefs. C. Following the behavior of the majority. D. Overestimating one's ability to predict market movements. Answer: B. Seeking information that supports pre-existing beliefs. 8. Which bias causes investors to follow the actions of others without independent analysis? A. Recency bias. B. Herd mentality. C. Loss aversion. D. Overconfidence. Answer: B. Herd mentality. 9. Loss aversion refers to A. Preferring to avoid losses rather than make gains. B. Being confident in investment decisions. C. Following recent trends in the market. D. Diversifying portfolios to minimize risk. Answer: A. Preferring to avoid losses rather than make gains. 10. Which strategy involves making changes to asset allocation based on changing market conditions? A. Strategic asset allocation. B. Tactical asset allocation. C. Diversification. D. Avoiding risk. Answer: B. Tactical asset allocation. 11. What is the main objective of strategic asset allocation? A. To maximize short-term profits. B. To reduce risk by holding only one asset. C. To align asset allocation with the financial goals of an individual. D. To follow market trends. Answer: C. To align asset allocation with the financial goals of an individual. 12. Rebalancing a portfolio involves A. Increasing the risk profile of an investor. B. Adjusting asset allocation to restore original targets. C. Removing all high-risk assets. D. Focusing only on equity investments. Answer: B. Adjusting asset allocation to restore original targets. 13. Why is rebalancing recommended in strategic asset allocation? A. It ensures constant risk levels over time. B. It allows the investor to sell high and buy low. C. It eliminates the need for diversification. D. It follows recent market trends. Answer, B. It allows the investor to sell high and buy low. 14. What does risk profiling evaluate in an investor? A. The best performing stocks. B. The investor's risk appetite. C. The recent market trends. D. The amount of taxes to be paid. Answer, B. The investor's risk appetite. 15. Overconfidence in investing can lead to A. Underestimating risks. B. Diversifying the portfolio. C. Following the crowd. D. Avoiding investments altogether. Answer, A. Underestimating risks. 16. Which bias leads to an investor allocating more to risky assets after a bull market? A. Recency bias. B. Loss aversion. C. Availability heuristic. D. Herd mentality. Answer, A. Recency bias. 17. How does familiarity bias affect an investor's portfolio? A. Encourages diversification across various assets. B. Leads to concentration in familiar investments. C. Helps an investor take on higher risks. D. Forces investors to follow the crowd. Answer, B. Leads to concentration in familiar investments. 18. What is tactical asset allocation often referred to as? A. Dynamic asset allocation. B. Strategic allocation. C. Risk-free investing. D. Rebalancing. Answer, A. Dynamic asset allocation. 19. Which behavioral bias explains why investors avoid profitable opportunities due to perceived risks? A. Overconfidence. B. Familiarity bias. C. Loss aversion. D. Herd mentality. Answer, C. Loss aversion. 20. What happens during the rebalancing process of a portfolio? A. The portfolio is restructured to minimize losses. B. The investor sells low-performing assets and buys high-performing ones. C. Asset allocation is adjusted to restore original targets. D. The investor avoids making changes based on market trends. Answer, C. Asset allocation is adjusted to restore original targets. 21. What role do ethical standards play in investment behavior? A. They encourage unethical investment practices. B. They help in maintaining discipline and long-term wealth creation. C. They encourage taking high risks for quick profits. D. They have no impact on investment behavior. Answer, B. They help in maintaining discipline and long-term wealth creation. 22. The need to take risk arises from A. The investor's desire to earn the highest returns possible. B. The investor's financial ability to withstand losses. C. The requirement to achieve financial goals. D. The recent market conditions. Answer, C. The requirement to achieve financial goals. 23. Why is rebalancing needed in tactical asset allocation? A. To ensure all assets perform equally. B. To adjust the portfolio according to changing market conditions. C. To increase portfolio returns at all costs. D. To avoid taking risks. Answer, B. To adjust the portfolio according to changing market conditions. 24. Which behavioral bias explains the tendency to invest more in what is known rather than exploring new options? A. Recency bias. B. Herd mentality. C. Familiarity bias. D. Overconfidence. Answer, C. Familiarity bias. 25. What is the primary goal of tactical asset allocation? A. To increase risk without increasing returns. B. To reduce risk-adjusted returns. C. To improve the risk-adjusted return of the portfolio. D. To eliminate all risks from the portfolio. Answer, C. To improve the risk-adjusted return of the portfolio. 26. What is the purpose of rebalancing in asset allocation? A. To keep asset values constant. B. To restore target asset allocation after market movements. C. To eliminate risk from the portfolio. D. To focus only on high return assets. Answer, B. To restore target asset allocation after market movements. 27. What is an example of strategic asset allocation? A. Changing investments based on short-term market trends. B. Maintaining a target asset allocation aligned with financial goals. C. Investing in high-risk stocks for quick gains. D. Avoiding all forms of risk. Answer, B. Maintaining a target asset allocation aligned with financial goals. 28. How does herd mentality affect investment decisions? A. It encourages independent analysis of market trends. B. It leads to following others without proper analysis. C. It improves portfolio diversification. D. It helps reduce the impact of biases. Answer, B. It leads to following others without proper analysis. 29. What should investors do to reduce behavioral biases in decision-making? A. Rely on their emotions. B. Consult a registered investment advisor, RIA. C. Follow recent trends closely. D. Ignore market research. Answer, B. Consult a registered investment advisor, RIA. 30. What does a risk profiler evaluate? A. The asset performance over time. B. The financial needs and goals of the investor. C. The investor's market knowledge. D. The investor's risk appetite, including willingness, ability, and need to take risks. Answer, D. The investor's risk appetite, including willingness, ability, and need to take risks.